Bitcoin outflows have soared by over 170%, while inflows have quietly dipped. Could this be the biggest calm before the crypto storm we have ever witnessed? That might sound dramatic, but the numbers do not lie. Today we are diving headfirst into Bitcoin's intriguing standstill, the tug-of-war between bullish accumulation signals and cautious sentiment, and the million-dollar question: is the market on the cusp of a seismic breakout, or will it flatline until the next burst of real demand? So, what is really going on in the crypto kingdom? And how does a sudden surge in exchange outflows, combined with uncertainty in Bitcoin sentiment, set us up for a potential rollercoaster ride in the coming weeks or months? In this comprehensive exploration, we will peel back the layers, discover how miners quietly influence price movements behind the scenes, and figure out if all these wavering funding rates are evidence of a market waiting to pounce, to the upside or the downside. In this deep dive, we will uncover why exchange outflows are shooting through the roof, how some institutions are amassing Bitcoin without making a big fuss, what the Puell multiple has to do with miner sell pressure, and whether anyone truly has the guts to drive a meaningful rally in the short term. We will also examine the stability of the order book, the seesawing sentiment across major platforms, and what it all might mean for you, especially if you are wondering whether this is the perfect time to join the ranks of the quiet accumulators, or if you should brace yourself for a rocky summer. Let us go back a bit. For much of this year, we have witnessed multiple ups and downs in Bitcoin's price. That is hardly new. If you have been around this market for more than a few months, you know that Bitcoin thrives on volatility. But recently, there has been a bizarre hush. The once adventurous traders on futures markets have taken a breather. The 90-day futures taker CVD, that revered metric capturing the aggregate aggression of longs versus shorts, went neutral. One might think, neutral? That is hardly headline-worthy. But in Bitcoin, a neutral stance after a period of directional mania can be the most potent precursor to a dramatic shift. On top of that, order book data from major exchanges shows an interesting distribution of liquidity. Binance, one of the biggest fish in the crypto ocean, leads with around $8 million in combined order book depth, within a spread of roughly $100. BitGet and OKX come next, each with a few $1 million in bid and ask depth, painting the picture of a series of well-defended price levels. With stable liquidity clustered in relatively narrow ranges, it is almost like placing a lid on a boiling pot. The question is, can that lid hold? The tension is bubbling, and we do not know how big the eruption could be if the heat intensifies. Next, we turn to a phenomenon that often gets overlooked: exchange outflows. When outflows skyrocket, it typically suggests that market participants, be they long-term investors or short-term swing traders, are plucking their coins from exchanges. This can happen for many reasons, but the big one is typically an intent to hold, not to flip. If people wanted to sell, they would keep their BTC on the exchange, waiting for the moment to click that sell button. The increase in outflows, well over 170%, reveals that some folks are bundling up their chips, fueling speculation that they expect a positive price move down the line. Meanwhile, a 6% dip in exchange inflows completes the picture. More BTC is pouring out, less is pouring in, so there is a net effect of supply reduction on the exchanges. This intriguing pattern often precedes bullish movements. So, you might wonder, where is the surge in the price? That leads us to the next puzzle piece: the actual demand for Bitcoin. Demand is not always immediate. Sometimes it lags behind accumulation. Traders could be steadily removing BTC from exchanges in anticipation of events that might be days, weeks, or even months away. So, we are left playing a game of patience, waiting for the final wave of fresh buyers, or even a market-moving catalyst that triggers a decisive breakout. But hold on, the mining sector also has a crucial role in this drama. Recent data shows that the Puell multiple has dropped sharply, by 37%, to around 1.0. For those who are not familiar, the Puell multiple is a measure of daily coin issuance divided by the yearly average of that issuance. When it is near or below 1, that suggests that miners, generally speaking, are not under high pressure to offload their newly minted coins. If miners felt the sting of unprofitability or faced severe overhead costs, they would likely flood the market with their Bitcoin rewards, adding downward pressure to the price. Instead, the multiple's current reading suggests that miners can hold on. They are not forced to sell aggressively. That takes away one big chunk of potential supply that could weigh down the market. All these signals, steep outflows, calm miners, seem to point toward a supportive structure for Bitcoin's price. And yet, the mood among market participants remains apprehensive. Weighted sentiment, a broad measure encapsulating various mood signals across social and trading platforms, is clinging to a slightly negative value. Why so gloomy if the on-chain signals are pointing to mild bullishness? Part of this might be the result of macroeconomic uncertainty, as investors weigh global economic trends, interest rates, inflation data, and the regulatory climate that keeps overshadowing the crypto realm. Another part might be leftover caution from the rapid reversals seen earlier in the year, where every short-lived rally was followed by discouraging corrections. Put simply, many participants have been burned before, and they are not ready to jump in wholeheartedly until they see a robust confirmation. When we look at the leverage side of the market, the story remains murky. Funding rates, especially on major platforms like Binance, are flitting between positive and negative, never staying in one territory long enough to inspire lasting confidence or fear. In many cases, a consistently positive funding rate suggests that longs are dominant, while a persistently negative rate signals that shorts are driving the momentum. The fact that it is flipping so frequently suggests few traders are interested in committing to a long or short position for more than a brief window. It is a chessboard with pieces refusing to move from their starting squares. So, what does all this mean for you and me, the curious or maybe anxious onlookers? It could signal a time to watch carefully for any spark that might set the market off on a tear in one direction or another. The neutral energy we are seeing implies that many are waiting for a definitive sign. Perhaps it is a large institutional buy, a sudden piece of macro news, or a major shift in global risk sentiment. In crypto, breakthroughs can happen when you least expect them, often triggered by a cascade of positions, flipping bullish or bearish in rapid succession. Now, do these conditions automatically mean Bitcoin will leap to new highs? Not necessarily. We have to remember that just because outflows are up and miners are relaxed does not mean the capital needed to drive the price to the moon is guaranteed. It could also suggest that people who have locked up their BTC are satisfied to sit on the sidelines and watch for a while, effectively removing liquidity from the market. If that decreased liquidity meets a powerful wave of demand, it can produce rapid price appreciation. But if demand never manifests, the reduced liquidity might also mean an ominous vulnerability to any selling pressure. In that scenario, a moderate round of selling could produce a steeper drop, since fewer coins are available on exchanges to absorb the shock. So, we stand at an equilibrium of sorts. On the structural side, the core signals, like outflows and miner behavior, lean bullish. On the psychology side, the jitters remain. One might say we are at a turning point, reminiscent of those moments in classic dramas where both armies stand face to face, neither wanting to sound the trumpet for attack. This is that tense standoff before the inevitable clash. And in Bitcoin's case, the question is not if a clash will occur, but when. Before we go further, let us remember that enthusiasm for crypto has always been fueled by community engagement. If you find this analysis helpful and want to stay tuned for more in-depth breakdowns, please take a second to smash that like button. It might seem like a small gesture, but it helps gauge whether topics like these resonate with you. Thank you for being here, by the way. It means a lot that you are giving your time to delve into these nuances with me. Now, let us pivot back to the psychological underpinnings, sentiment and funding. The weighted sentiment is slightly negative, which can be read in two ways. The first interpretation, it is a sign that investors are not convinced of an uptrend and are therefore more cautious. That caution can lead to historically lower volatility, as nobody wants to place big bets. The second interpretation, negativity might be a contrarian signal, a sign that if the environment is actually more constructive than people believe, a wave of short covering or eventual FOMO, fear of missing out, could kick off if the price begins to climb. We have seen it time and again. Pessimism flips into mania faster than you can say Satoshi. But that mania needs a catalyst, something beyond the usual day-to-day churn of on-chain data. Meanwhile, from a purely structural standpoint, BTC's order books are not exactly shallow. Exchanges such as Binance, BitGet, and OKX each maintain decent depth. That tends to mitigate wild swings. But do not be fooled. If a powerful enough wave of buying or selling hits, even the best liquidity can dissolve shockingly quickly. It is a bit like looking at an olive branch on a windy day. It might seem stable, but a strong gust can still snap it. The The same goes for crypto liquidity. Let us also consider how miners fit into the supply puzzle over the longer horizon. The Puel multiple near 1.0 means many miners might just be breaking even or slightly profitable, with no urgent reason to liquidate their stash. But if the global economy moves in an unpredictable direction, maybe energy prices spike, or financing costs for mining operations shoot upward, those same miners could be forced to sell more aggressively than expected, reversing that supportive dynamic. At present, they appear relatively comfortable, which alleviates downward pressure for now, but this too can change quickly. Another piece to consider is the possibility of unexpected regulatory developments or macro shifts. Over the last few years, we have seen how quickly a single announcement, be it from a major government or financial institution, can rattle the entire market. Because everyone seems to be in wait-and-see mode, the impact of such news might be magnified. Fewer traders are actively hedging or maintaining large directional bets. That means if a shock hits, it can catch people flat-footed, triggering significant price swings in either direction. So, is the next move going to be explosive? The honest answer? Nobody knows. But the conditions for a big move are taking shape. When you have a mix of uncertain sentiment, strong on-chain fundamentals, calm but noticeable spot liquidity, and derivatives data that shows no one is stepping up to force a direction, it can be like a tinderbox waiting for a match. If the spark is bullish, perhaps a major institution invests in Bitcoin or sentiment shifts after a favorable regulatory stance, it could trigger a wave of buying, capitalizing on the smaller supply in exchanges. Conversely, if something spooks the market, an unfavorable policy, a hacking scandal, or a global equity meltdown, people might scramble to sell, discovering that liquidity, while decent on the books, may not be robust enough to absorb a sudden avalanche. And we have not even considered the personal dimension. How does all this affect individual holders? If you are a long-term believer in Bitcoin, the data about outflows and miners might bolster your conviction that the current lull is a chance to accumulate. Many see this period as an opportunity to buy Bitcoin without the frenzy of a raging bull market. On the flip side, if you observe the skittish sentiment and flipping funding rates, you might decide to hedge or wait for a clear signal before committing fresh capital. The same tension applies to big players as well. Hedge funds or institutional desks that have mandates to invest in crypto are not going to jump in if they see no impetus for immediate growth. They might wait for solid confirmation, like a break above a key technical resistance or a major improvement in sentiment indicators, before dedicating resources. We have seen black swan moves in the past, where a single large entity's decision cascades into unstoppable momentum. But that is the nature of a market in equilibrium. It just takes one flick to tip the balance. To keep watchers on the edge of their seats, the funding rate stamp of unpredictability is crucial. Normally, you might rely on stable funding rates to gauge who has the upper hand, longs or shorts. Instead, the rapid flipping from positive to negative and back again demonstrates the collective indecision. 1 hour, it looks like bulls are stepping up. The next, it seems bears are roaring back. This tug of war highlights how fragile the equilibrium truly is, and how swiftly it might snap when a real impetus emerges. If you are as fascinated as I am by this living, breathing puzzle of Bitcoin's price action, please consider subscribing for future dives into on-chain data, market sentiment, and behind-the-scenes power plays. By staying informed, you can better position yourself for those pivotal shifts, whether they indicate a bullish leap or a defensive retreat. We want you right here alongside us, decoding the signals together. Let us continue our deeper dig by returning to that weighted sentiment. One might ask, if everything is pointing to accumulation, why are people still negative? The complexities of human psychology come into play. Crypto euphoria can vanish as quickly as it arrives, especially after a rough period of volatility. Some investors are battered by the seesaw of big rallies followed by merciless dumps. It is only natural that they keep their guard up. Another reason might be the broader economy. With inflation rates, central bank policies, and job market instability, some folks have bigger concerns than optimizing their Bitcoin stash. Yet, as we look at historical precedents, near-neutral taker CVDs often mark a kind of transitional phase, as if the market has taken a step back to catch its breath after an intense run. It is that moment of potential energy building up. Meanwhile, outflow data suggests that the holders who choose to acquire BTC are not doing it for a quick flip. They might be storing their BTC in offline wallets, possibly anticipating that the next move is still months away, or that a halving event in 2024 year might eventually draw in a fresh wave of demand. This subtle optimism runs beneath the negative weighted sentiment, indicating a contradictory cross-current of macro-scale bullishness and short-term uncertainty. On the miner front, let us not trivialize their role. Miners have historically been forced sellers during times of heavy operational strain. Their selling can push prices down at the worst possible moments, exacerbating negative cycles. But the data now shows that they have no urgent reason to dump their newly minted coins. This single factor has been enough to stave off deeper corrections in the past. Without that constant fear of miner capitulation, the foundation under Bitcoin seems steadier. Still, because sentiment is so delicate, it might only take one or two major events, like a blow to the global energy market or some regulatory crackdown that raises operational costs, to turn that dynamic on its head. For now, though, the respite from miner selling is an important piece of the bullish argument. Zooming out, it is remarkable to see how the entire market can hang in a balance like this. On one side are the hopeful signs, historically meaningful outflow patterns, ease on miners, and decent liquidity. On the other side stands the cautious crowd, uncertain funding rates, and negative weighted sentiment. Both sides have strong rationales. Both sides wait for confirmation. So the question becomes, which side will flinch first? That is truly the crux of the entire narrative, because once a certain threshold is crossed, be it a price level or a psychological tipping point, momentum can build extremely fast. One tried and true approach for watchers is to keep a keen eye on the order books each day. A sudden influx of large buy walls or a quick disappearance of sell walls can herald the immediate future. Or a shift in derivatives, such as sustained positive funding rates over a series of days, might signal that bulls are ready to charge. Another angle is to monitor that weighted sentiment for abrupt changes. If negativity flips to positivity, it could reflect a wave of fresh optimism that might precipitate a breakout. People who track these metrics in real time often get a head start on spotting the pivot from equilibrium to expansion. Despite the tension, do not forget that Bitcoin remains a global asset with a notoriously loyal community. That means any external catalyst, from a mainstream media blitz to a surprise endorsement by a tech magnate, can detonate a cascade of hype. In a more stable asset class, we might shrug off such items. But in crypto, hype can be a self-fulfilling prophecy. With outflows so high right now, supply on exchanges might be limited enough that a strong wave of hype-driven buyers could send the price soaring, a scenario reminiscent of previous bullish runs. Alternatively, if a negative storyline emerges, maybe a security scare or an exchange meltdown, it could chase investors away just as quickly, leading to sharp declines. In these moments of calm, it pays to remain cool yet attentive. Market veterans often describe these phases as times to plan your moves precisely. There is less of the frenetic unpredictability that plagues periods of extreme volatility, giving you breathing room to perform thorough research and to decide if you believe the bullish or bearish thesis. Will the accumulation narrative triumph, or will the tepid sentiment prove to be a self-fulfilling prophecy of stunted price action? What happens next might determine how Bitcoin is perceived for the remainder of the year. An underwhelming asset that fails to catch momentum, or a tempest in a teapot that was simply waiting for the right breeze. One historical trend that some investors cling to is that Bitcoin often thrives on having hype and cyclical waves of mainstream interest. However, those cycles do not always follow the script perfectly, something many discovered during the last couple of years of unprecedented global upheavals. Here is a final angle that sometimes goes underappreciated: the interplay between short-term traders and long-term hodlers. This is a constant dance. Long-termers are pulling BTC off exchanges, presumably to keep them safe. Short-termers, they see the funding rates flipping, and they think, this is not my time to shine just yet. That push and pull is what creates equilibrium. It is basically the cyclical breath of the Bitcoin market. If at any point, a confident wave of short-term traders piles in on an obvious direction, that could break the lull. And if that wave aligns with the pre-existing long-term positivity, the synergy could be explosive. To wrap it up, we have a market that is quietly preparing for its next act. Will it be a triumphant crescendo of bullish activity, or a downward slide triggered by lingering negativity? Given the nature of Bitcoin, both outcomes remain firmly within the realm of possibility. The data you have seen, exchange outflows, miner health, sentiment, and derivatives, serves as a mosaic. Each tile forms part of the grand picture, but the full image only emerges when the collective whim of the market chooses a direction. Thank you for staying with me on this thorough journey. If you found any of these insights intriguing, please remember that your support makes a big impact. Share your thoughts in the comments or pass this along to someone curious about Bitcoin's current standoff. Stay tuned, stay prepared, and remember, in crypto, the moment you think nothing is happening might just be the pivotal calm before a storm that redefines the conversation for months to come.